Hey guys, welcome back. Quick tip video for you here. Going to explain how to know that you've got your max profit before you close out of a debit spread. Okay, I've got a call debit spread here on Square. I have 157.5 call and 160 call. And let's explain what that is really quick. Here it is. So a call debit spread is when you buy a call and you sell a call, but the call you buy is more expensive than the call you sell because it's closer to the strike price. So I bought this is plus two. I bought two contracts, two option contracts for $157.5 strike price call that expires September 11th. Always remember, never forget. I sold two contracts at $160 strike price. That was a call that expires November 11th. Always remember, never forget. And with this, I got a credit. And this I had to pay. So since this number is greater than this number, I had to pay. Now this is a call debit spread. A call credit spread would be if I changed these around and I was credited money. But this one I'm spending money. It basically makes naked long call, it makes it cheaper, and it makes it less prone to theta decay, but it also caps your gains. So here I'm gonna explain how to know when you're at your max profitability on a debit spread, a call debit spread. So basically I like to use Options Profit Calculator. This is a pretty cool website. It just real basic. Breaks things down for you, which is kind of nice. Since I got into this position, let's see, like over a week ago, it's changed quite a bit now, but I put it in. You put your symbol in Square, the current price, and then I put buy. Let me do this with it. So what we did is we bought September 11th. So I selected the option for the September 11th expiration, and then it was a call. And it was for 157.5. That's what we bought. We bought two of them. So I have two contracts. And then I put in my manual price per option because the price per option right now for that contract is different. So typically if you're doing this before you open up a position, you can just choose whatever call you want to test out and it'll have the right price. But I'm just showing what the chart looks like at this point for me. And then I sold, or I wrote, writing a contract is the same as selling a contract. I sold the 160 for the September 11th. Always remember, never forget. Price per contract, it costs $3.30. Why did I do that? It costs $3.30. I have two of them. Okay, so this says total cost on both. This one, it's not a cost, it's a credit. But basically in the end here, it shows the spread. It's a net debit, which means you're paying. So I was paying 52 cents. 52 cents for the two contracts. Total entry cost is 104, which we have right here, 104. And then down here it shows the chart on where we can get our gains. So basically up here, the maximum gain we can get on this position is 374%, or $396. Okay, so let's go back and look at I'll show you where it's at right now. It cost me $104. So far we're up $66 total on it. So if I was to close it right now, I mean, there's a pretty big spread on that. But say I closed it for $1.10, that'd be best case scenario. Then I'd close two of them. So then we'd be given a credit of $2.20. So then subtract your cost from your credit, and that's how much you'd make. However, to know your max gain, the best way. Okay, so I had an Option Profit Calculator open just to kind of show you guys on the chart a visual representation. The quick way though is to subtract, take your two option strike prices. In this case, it's 160 and 157. You know, I have a contract for this and a contract for this. Take the 160, minus it by 157.5. Didn't do that right. 157.5. Okay, and then I subtract the cost it cost me to get into the position, which in this case was 52 cents. That's 0.52, because I'm just doing one contract here. I'm just showing one contract. And then that equals negative 156. Right there. Oh. What did I do? Why did it do 0.52 minus 157? Okay. 160 minus 157.5. Take that number and subtract it by how much it costs to get into the position. So the debit you spent, which was a minus 0.52 cents per contract. There. $1.98. You times that by 2, because I have 2 contracts. $396 if you move the decimal point over 2, which is what you do because it's times 100 since it's 100 shares. So there you go, $396. That's what this is showing also. Maximum return right here, $396. So you do 160 in this case minus 157.5, which is the difference in those two. The difference in your 2 strike prices on your contracts minus the cost for the position to be opened, which was 0.52, 52 cents. So 198. If you just had one contract, your max gain would be $198. But then I hope you're, yeah. So I have 2 of them, so I'm times that by 2. So total gain. But if you're going to close it out, you take that 198. So this is what you can do. You can do, okay, so I know my max gain is $1.98 per contract. I'll put that in there. I have 2 contracts. I'll sell them both. $3.96. That's right. Okay. And then I'll review order. I'll change that to, whoops, good till canceled. Review order, submit. Don't even have to worry about it. And you know, if it goes up to your max gain, it'll sell it out for you automatically. Of course, you don't have to wait till max gain. You can sell it out now, and I can make $66 if, you know, I sold it, put $1 in here for strike price or for limit price. You know, something like that would probably get filled. Then I'd make almost $100 on it. But for me, I think Square is going to probably go up to this 160, and this is where you can look at this thing for the expiration and everything. So I think by September 11th, it will be, it's got to be at 166 by September 11th, which I think it will. Yeah, that's 166. Yeah, or no, this is September 11th expiry. Yeah, okay, so at the end of September 11th. But depending on who your broker is, they might close it out for you earlier. So really want to do probably a day back. But yeah, so I think it'll be up in this range by that point. So I'm going to wait probably till max gain or until I think it's reversing in some way. It reversed a little bit today, but then now it's kind of coming back up. So it's just got a weird consolidation pattern. Man, it's hard for me to read these Square charts. I use Weeble. But that's how you get calculate your max gain. It's pretty simple. I like to use a profitoptioncalculator.com website just to kind of get a visual of what's going on. But yeah, it's pretty straightforward. Let me show you where is it? Oh, here they are separated. But yeah, it's basically just subtracting the higher strike price, this one, from the lower strike price, and then subtracting how much it cost to get into that position, how much you basically paid, the debit you paid, and then that's your max gain. So if you want to get a higher max gain on the next one you do, you can have a bigger spread between these, between your the call you sold and the call you bought. Or you can go higher on your strike prices, basically to make the contract cheaper. There's lots of little ways you can do it, but that's my video for today. Make sure to like up, sub up, and comment down, and make your money happy money so it'll stick around. Thanks for watching, guys. We'll see you next time.